This is Project 2 for Finance 695. This is my selection of companies that were based on the financial analysis. The analysis factors that I used include the profitability ratios, including profit margin, return on assets, and return on equity. For return on equity, I broke it further down using DuPont analysis. With the DuPont analysis, I was actually able to look at asset turnover, the equity multiplier for leverage, and the operating margin for efficiency. Also, in addition to the equity multiplier, I was able to look at the times interest earned ratio for additional information on leverage. And I also used price earnings ratio and market to book ratio for market value ratios. The economic value added was used to find out what the economic profit was for the companies, and I also used the current ratio for liquidity. For the 18 companies that we had to choose from, I actually did my first cut based off of negative profitability. The 4 companies listed, Amedisys, Community Health, Gentiva, and Tenet, were all companies that had negative profitability, as you can see based on the figures for return on equity from 2013 until the current time. My second cut, I eliminated 2 other companies, Jacobs Engineering and URS. Both these companies had declining profitability, asset turnover, and liquidity, and they had negative economic value added figures. As you can see on the slide, the return on equity for both companies has declined, asset turnover has declined, current ratio is showing declines as well. There is a concern that for me that when the liquidity was getting lower and you had a lower rate for the asset management, including a lower return on equity, that is a big problem and makes you wonder whether or not there's a bigger problem with the company and how efficiently the company is being managed. You also, when I looked at the EVA, I'm not necessarily fond of companies that have negative EVAs. However, when you put the other 3 factors that are declining, including a negative EVA, I had to eliminate these 2 companies. My third cut involved 4 other companies, Autodesk, Fluor, CenturyLink, and Coca-Cola. Fluor is a environmental company, CenturyLink is a telecommunications company, Coca-Cola is a beverage company, and Autodesk deals with publishing. And so with these 4 companies, I did notice that there was a possible overvaluation for the market values. Price to earnings ratio. Now, the price to earnings ratio is the market price per reported earnings. So you're taking future expected cash flows and you're comparing it to earnings that were on the income statement. The market to book ratio, you're taking the market value in relation to what you think the book value would be. The book value is basically your assets minus the liabilities that you have, and that's what's left over, and that's basically the book value on the equity at the time. So if a company was to close down today, that book value is basically what they would be worth. The companies, these 4 companies actually were they all had inclines for the price to earnings, and they had expected declines ahead for both of the price to earnings and the market book ratios. And as you can see in this slide, you'll notice that there's some sharp inclines for the price to earnings ratio, but an estimated sharp decline for it. That is worrisome because you're looking at future expected cash flows. You're looking at they're valuing it very high right now, but it's expected to drop considerably. And then at the same time, you're looking at market to book ratios. This is more helps you out with historical values. So because of that, when you see, as it indicates in the slide, that you're looking at some slight declines, even a sharp decline with floor, and CenturyLink is relatively stagnant, but it actually has a raise in it. But the biggest concern is you don't have a lot of fluctuation with the market to book ratios, but you still have those sharp declines that are to come about. So that is a major concern for these companies, so I had to eliminate them. My fourth cut actually dealt with low liquidity, future estimated future declines in market values, and return on equity. Now, CB&I, Marathon Oil, and AT&T, they all have current ratios that are relatively low. CB&I and AT&T actually have current ratios that are below 1, so that means that their current assets aren't enough to take care of the current liabilities. So that is a concern, and Marathon Oil is right at 1, so that's kind of a concern as well. But as you can see, the return on equity for these three companies have shown that they're estimating some sharp declines in them. So a sharp decline in profitability, especially when it comes to the return on equity, is a major concern for me. And then when you look at the sharp declines that they're looking at for the price to earnings, at the same time as still having declines for the market to book ratio for 2015, that is a major concern as well. You're looking at a major increase for what you think is the market value, the market price for the stock right now, and then the next year you're estimating that it's going to drop considerably. Well, you can imagine that that is a very risky situation to be in. So I did eliminate those from the top 5. But there is something that I would like to focus on with AT&T. Even though AT&T is not in my top 5, I would definitely make it my number 6 pick. And that is mainly due to the fact that it utilizes leverage in magnifying the gains that they have. If you look at the equity multiplier from 2009 to 2014 has increased for AT&T. And then if you take the 3 major profitability margins that I've used in my analysis, profit margin, return on assets, and return on equity, from 2009 to 2014, all 3 of these are showing considerable increases. So to me, this is a very good way to show how debt or leverage is a good way to magnify gains. 5 top companies that I've chosen of the 18 total that we started with, all have some qualities in common. They all show increases in profitability, asset turnover, and operating margin. Monster Beverage, which is an energy drink company, Caterpillar and John Deere, which are both heavy machinery companies, Intuit, which is a company that specializes with computer softwares such as TurboTax and QuickBooks, and Valero, which is an energy company. All of these companies, I'm going to look when differentiating the top 5 at profitability, leverage, their market value ratios, and economic value added. For the heavy machinery companies, I actually considered Caterpillar as number 5 and John Deere or Deere & Company as number 4. Caterpillar actually has increases in liquidity, increases in times interest earned, asset turnover, profitability, and operating margin. Concern though for Caterpillar is that the estimates for market value levels are going to drop or potentially drop for 2015, and there's a negative EVA value. So there's project management budgeting concerns there. With John Deere actually I think pretty highly of this company. I did put it in the number 4 spot, specifically because it does have the increases to asset turnover, times interest earned, profitability, and operating margin, and the EVA is a very high positive number. However, there are some concerns that that there are some estimates for the profitability to decline and that operating margin is going to decline. They also have a lower liquidity. The current ratio is only at 0.74, and if you want to compare that to Caterpillar, that's within the same industry, they have a current ratio of 1.39. Now, John Deere and Company, they do have a price to earnings ratio that has lowered and is estimated to increase, while the market to book value has lowered and it's estimated to lower more. When you have a lower price to earnings ratio and you're expecting a rise, that is a good situation to be in, and that is potentially a good investment for you. So this is potentially an undervalued stock during a time that it has some good economic profit with their projects that they have, and that's apparent with their super high EVA value, or their EVA figure. And this is just a graphic representation of everything that I just talked about, with Caterpillar having a lower PE ratio, while with Deere and Company having a increasing PE ratio, and these are based on estimates for 2015. You're also looking at the market to book ratios. As you can see, a slight decline in both of them. Caterpillar is looking at an increase in the return on equity, and John Deere is looking at a potential decrease in the return on equity. But if you look at these EVA, Caterpillar in 2013 and 2014 have negative EVA, while John Deere can boast a very high EVA value, well beyond 2000. My next two picks are Intuit in the number 3 spot. Intuit has increases in liquidity, asset turnover times interest earned, profitability, market values, and operating margin with and they have a positive EVA. Concerns with Intuit, the profitability has estimated to possibly decline, and they do have a high market to book value, but that could be in part because of all of these increases in their with their financial ratios. The market may actually place a very high value on it, and with it not being a very capital intensive company, they may have a slightly lower book value than other companies. So because of that, that would actually boost up the market to book value ratio. The number 2 spot actually is for Valero. Valero actually looks very good when I did the financial analysis. They have increases in liquidity, asset turnover, times interest earned, profitability, and operating margin, and they have a very, very high positive EVA. The price to earnings ratio is actually declined, but it has estimates, future estimates, to increase, and at the same time the market to book ratio has actually increased, but it's looking to it has estimates to decline. This is kind of a good potential situation of a stock showing some undervalue. So if that is the case, you do have a potential for some high gains, and this company, its performance is looking pretty good. And this is just to show you with Intuit the increase of the price to earnings for both Intuit and Valero, and both of them are showing decreases to their market to book values, Intuit and Valero. And as I said, both of this being in this situation, you're looking at a potential gains with these price to earnings ratio showing potential increases for 2015, while the market to book is just showing us a slight decrease in both. My top pick, my number 1 pick, being Monster Beverage. Monster Beverage deals with energy drinks. Relatively new company on the market. I think they've been around since 2002. But this company has increases in leverage, asset turnover, return on equity, market values, and operating margin. It's had good economic profit figures for the past 5 years. It's a liquid company. It has a current ratio of 3.67. There are estimates that there are potential drops in market values for the future. However, a sharp drop in the market to book value may actually end up reaping a reward for an undervalued stock. Um, from externally, but something to consider with my financial analysis was last month in August of 2014, Monster actually had an agreement, a multi-billion dollar agreement with Coca-Cola. And in this agreement, Coca-Cola is actually handing over its energy drink portfolio, and that's including the Coca-Cola's Full Throttle and Burn products. So this is actually a considerable deal, and it's very recent agreement that's been made with Monster. So I definitely see some big potential gains for Monster. Um, the trends for Monster, with the news set aside, is UP ratio has gone up since 2009, increase in market to book since 2009. A return on equity has stayed somewhat constant, but it actually is showing a potential decline in 2014. But one thing that I found very good for Monster is that it's increased its asset turnover in the past 5 years, and it's increased its equity multiplier. So it's utilized leverage to its benefit. If you look at the EVA figures at the bottom of the slide for the past 5 or 6 years, actually since 2009, it has had a positive EVA, and it's had an increase. It keeps having a better and better EVA value each year. So it's showing that it has some good project management, and it's getting a good value back on its capital investment that it's putting into its projects. In conclusion, I would like to give the suggestion that going forward, I would look into diversifying my portfolio with possibly the top 5 to 7 companies that I discussed today. Number 7 and number 7 being CB&I, and number 6 being AT&T. The heavy machinery companies of Caterpillar and Deere being number 5 and 4. Intuit, number 3 company, and the number 2 company being Valero. And finally, my top pick being Monster. Although, my top pick, Monster, would be a great company and has a great potential, it's always a good idea to diversify, especially if you're going to do it among multiple industries. That keeps from having an industry-wide effect on your portfolio. So the diversification does help to minimize some of that risk and to keep it down. Thank you so much.